So do you want to increase your savings, increase your income, and at the same time reduce your taxes in retirement? You can do it, and it's perfectly legal. And it's all part of tax diversification. And most people don't know anything about it. So let's talk about tax diversification. Basically what it refers to, and we've talked about asset allocation or diversification in our investments, but tax diversification is using multiple account types. You see, every investment can be invested in three different ways: either taxable, tax deferred, or tax free. Now, what is a tax deferred account? That's something everybody pretty much uses, and we've been conditioned to invest in them. That's your traditional IRAs, your 403bs, your 401ks, or similar type of accounts. Most people have this through their employer. Okay, and what happens in these accounts is that you put money in. It like never shows up as income when you're putting money in. Okay, then inside of the account it grows tax deferred, but when you take it out, it's taxable. Now let's talk about tax-free accounts. Tax-free accounts are like a Roth or Roth 401k, where you put money in, okay, after tax dollars in, it grows in there basically tax deferred or tax free, and then when it comes out totally tax free. And then the third type is what is called a taxable account. And a taxable account is like your brokerage account, your savings account, even a CD at the bank. So while this investment in there is growing, you're paying taxes on the interest it might put out, on the dividends it might put out, on the capital gains it might put out. And at some point down the line, for example, if you sell it at a gain, so you bought it for 50 and sell it at 100, you're paying taxes on that too. So why do we use tax diversification? Because again, when you contribute to these 401ks, when you contribute to these IRAs, when you contribute to these employer plans, you have a tendency over time, over the span of 30 or 40 years, okay, you compile a big giant bucket of money that's never been taxed. You've been putting money in, your employer has been putting money in, and at the same thing, this thing's been growing. So what happens is that over time, this thing has the potential to be really, really big, and most of them are. And now when you take money out of it at your retirement, when you're usually have less standard deductions or less itemized deductions, or less deductions in general from a tax perspective, and have more income or similar income, what all this money has the ability to do is when you combine it with Social Security and your pension, other buckets of income that have never been taxed, now all of a sudden you're paying higher and higher and higher and higher and higher and higher taxes every single year in your retirement. Okay, so what we want to do is try to diversify the mix between taxable, tax deferred, and tax free to give you a more flexible income stream and the ability to pay less taxes at retirement. Because one of the things to understand is that if you're paying less taxes, okay, and you're generating more income, what that means is that from an investment standpoint, you don't have to be that aggressive, because already you are paying less taxes and your income is coming up more tax favorable or more favorable to you. Okay. Now, people say, well, which is best? Well, if you kind of take it into account, obviously if you do it all tax free would be best. However, I prefer sort of a blend of all three, and that blend depends on the person. But one of the things to understand is if you're working and your employer is matching your contributions into your 401k, they're not going to match it into the Roth component. Okay, so you're sort of stuck in balancing it out a little bit. Okay, so why again is it important to have tax diversification? Okay, one of the things that people are conditioned to is to put money away again in their 401ks and their IRAs and their 403bs and employer type plans. Okay. Now, many people do this for a variety of reasons. Obviously, one of the biggest reasons is the match. Okay. But guess what is the lowdown on these 401ks and IRAs? Okay. Is that they don't belong to you. Actually, you're in partnership with Uncle Sam. And Uncle Sam has an inherent interest in you putting a bunch of money into these type of accounts because they know that they're going to get paid. Okay? And you know what also they know? They know that they can get paid whatever they want because at any point along the way, you're putting money in, they can change the rules. They can become a partner that wants a lot more percentage than you anticipated them having. Okay. Also understand that if you have $1 million in your 401k and you called, the custodian to get that $1 million out, that $1 million doesn't belong to you. Okay. A big percentage of that money actually is sent over to Uncle Sam as your partner in the investment. The other thing to understand is that based on the current fiscal path that our country is in from the standpoint of its debt, all the debt, okay, future tax rates are going to have to more than double for our country to not go broke. Okay, that's just pure, simple math. Okay, that's without even taking into consideration all the additional things that politicians want to do. Okay, so again, there are simple, easy ways to do a better diversification, not only of your investments but of your taxes, so that when you retire, you're at paying less taxes, you have more money, and you have more income. And with that, I'll see you next time on Financial QB TV.